Hello again, everyone. This is the second discussion video for Chapter 11, but I thought I'd mix in some more review questions before we get back to the Chapter 11 material. So first up, let's assume you're a division manager. Suppose you suspect that one of your product line managers is having problems with their materials supplier. You've heard rumors that the supplier has been providing low quality materials, which may be leading to excessive waste and lots of rework of finished units of product. Which of the following variances would help best confirm your suspicions before speaking to the product line manager? So give these a look, think about that for a second, pause the video, come back for the solution when you're ready. So our best bet there is C, the materials quantity variance and the direct labor efficiency variance. So that quantity variance is going to speak to excessive waste, right, and rework. The labor efficiency variance is going to potentially show that people are having to do things twice, so it's taking longer to crank out every finished unit of product relative to our standard. So there's just a couple things for us to keep in mind with regard to some of our variances from Chapter 10. Suppose you're a division manager in your firm again. You oversee three different subunits, A, B, and C. A has assets of $400,000, B has assets of $1,500,000, and C has assets of $900,000. This is average operating assets, just to be more explicit. If you want to be able to compare the relative performance of these subunits to determine who's doing the best at the moment, which performance measure provides the best comparability? Think about that for a moment, pause the video here, and then come back for the solution. A, return on investment is our best bet. So we did say one potential shortcoming of residual income is that comparability doesn't work out very well. If divisions have very different sizes, so the different average operating assets, by nature they're going to have differences in residual income due to that difference in size. So return on investment, though, it tells us the return relative to the investment. So that gives us better kind of side-by-side comparability. Last year, Division A's net income was $54,000. Its ROI was 18%. If the division's residual income in the same period was $9,000, then the company's required rate of return on investments must have been what? So again, pause this, work through the problem, come back when you're ready for the solution. That would be B, 15%. So we're saying their ROI was 18%, which would equal their net income of $54,000 divided by their average operating assets, which would be unknown. We can back solve though and get assets of $300,000 here. Residual income of $9,000 then would be equal to the net income of $54,000 minus the assets of $300,000 times that required rate of return. Now simplifying, we've got $9,000 equal to $54,000 minus the $45,000. $45,000 equaling $300,000 then times that required rate of return. Required rate of return's got to be 15%. 45 divided by the 300,000. And one thing I'd point out here with ROI and residual income, if we're looking at both, we can always do sort of that quick logic check. And by that I mean ROI was 18% and residual income was positive. So we know that the required rate of return has got to be something less than 18%. So in this case, we could have only ruled out 22%, but at least it's something. At least it's sort of that double check for us. Okay, that brings us to learning objective 3. We want to determine the range, if any, within which a negotiated transfer price should fall. So a transfer price is the price charged internally from one division or segment to another. A lot of times organizations, especially bigger ones, have different parts of the organization that serve products to other parts. And a transfer price is just that sort of internal price that we'd set between divisions. Now, the fundamental objective in setting transfer prices is to motivate managers to act in a way that fits the best interest of the company as a whole. So we don't want managers kind of competing against each other to kind of exploit each other in these transfer prices. We want to make sure that those things are being set where total profitability for the company as a whole is being maximized. Now, there are three primary approaches to setting transfer prices. First is negotiated, where we have managers get together and kind of figure it out. Second would be transfers at cost to the selling division. And third would be transfers at market price. And we'd be talking about an external market price. So what these things could be bought at externally or from another person, a third-party supplier. Now, a negotiated transfer price does result from some kind of discussion between managers of the selling and buying divisions. Advantages of taking this approach to setting transfer prices is that they, at least in theory, preserve the autonomy of the divisions, which is consistent with this idea and spirit of decentralization that we discussed. We've got the two managers coming together, kind of controlling their own part of the world and working together to figure out a reasonable transfer price. Related to our points about decentralization, the managers negotiating these transfer prices in this case are likely to have the best information about potential costs and benefits of the transfer than others in the company. So certainly better information than top-level management who aren't as familiar with each lower-level part of the business or operation. Now in these cases, we're looking for a range of acceptable transfer prices. The upper limit is determined in this case by the buying division, right? The most they're sort of willing to pay, so to speak. And then the lower limit would be determined by the selling division, kind of the cheapest they're willing to let these things go for or sell for. Now let's use an example here to illustrate what we're talking about in a potential negotiated transfer price. Assume the information here with respect to West Coast Plantations and Grocery Mart, and both companies are owned by Grocery Storehouse, some big conglomerate. Let's say West Coast Plantations has the ability to harvest 10,000 crates of navel oranges every month. Let's say the variable cost per crate of those things is $10. They have fixed cost in total per month of $100,000. And let's say that the selling price of these oranges on the outside market is $25 per crate. Let's also say that Grocery Mart is purchasing navel oranges currently for $20 per crate, and that they turn around and sell 1,000 crates of navel oranges in their stores every single month. Let's see if there's a possible transfer price between West Coast Plantations and Grocery Mart that makes the parent company, Grocery Storehouse, better off as a whole. So the selling division, that's the West Coast Plantations here, their lowest acceptable transfer price is going to be determined as the variable cost per unit, in this case per crate of oranges, plus any opportunity cost of doing this internal transfer. So that'll be defined as the total contribution margin on lost sales to external parties divided by the total number of units transferred. Now in this case, this may be zero in some times where there's excess capacity, and that obviously makes the decision a little bit easier, but just something we want to keep in mind. There is this potential opportunity cost. Now the buying division, Grocery Mart, their highest acceptable transfer price is going to be calculated as the cost of buying from the outside supplier. Quite simply, we don't want Grocery Mart to pay more internally to this West Coast Plantations piece of the organization than they could just turn around and buy it in the outside market, right? That wouldn't make a lot of sense. So if an outside supplier doesn't exist, though, the highest acceptable transfer price would be determined as the profit to be earned per unit sold, not including that transfer price. Now, if West Coast Plantations has sufficient idle capacity, as I was hinting at a minute ago, 3,000 crates, let's say, to satisfy Grocery Mart's demands of just 1,000 crates, without sacrificing sales to other customers, then the lowest and highest possible transfer prices are going to be what we've got here. From the selling division standpoint, again, the variable cost per unit, that $10 per crate in variable cost, plus nothing. So plus no lost contribution margin on external sales. So the lowest possible transfer price, West Coast Plantations, they're going to say the lowest I'm going to let that go for, $10 per crate. Now in the buying division's case, Grocery Mart, their highest possible transfer price is the cost of buying from the outside supplier, less than or equal to that. So that was $20 per crate. So here we do have a range of acceptable transfer prices. In other words, anything between $10 and $20 is going to make it worth it for the company as a whole to execute this transfer internally rather than having Grocery Mart buying their stuff from the external supplier and West Coast Plantations trying to sell this in the open market as well. Okay, anything between 10 and 20 makes sense. Now let's assume instead that West Coast Plantations has no idle capacity. So they're currently selling everything they produce to outside customers. And in order to fill Grocery Mart's demands of 1,000 crates, then they're going to have to give up 1,000 crates of regular sales to fill that internal transfer. That changes the equation. Now the lowest possible transfer price for West Coast Plantations is going to be the $10 variable cost per crate plus that lost contribution margin on external sales. So that's the $25 normal selling price minus the contribution margin the variable expense of $10. So a CM, if you will, of $15 per crate times 1,000 crates, and then technically divided by the total number of crates transferred, which is the same 1,000. So in essence, we end up with $10 plus the $15 opportunity cost, if you will, for a price of $25. Now, in the case of the buying division, their highest possible transfer price does not change. It still should be less than or equal to the cost of buying from that outside supplier, so $20. Here then, there's no range of acceptable transfer prices that makes any kind of sense, right? The buying division, the Grocery Mart, they're not going to want to pay $25 internally when they can buy externally for $20. And West Coast Plantations isn't going to want to transfer internally for $20 when they're selling externally for this total cost, if you will, of $25 when we incorporate an opportunity cost. So there's no acceptable range here of transfer prices that makes sense for the company as a whole. Let's think about a third scenario. Let's say West Coast Plantations has some idle capacity, 500 crates, and they only have to give up 500 crates of normal sales to external customers to meet Grocery Mart's demands of 1,000 crates. Let's see how that changes the dynamic here. So the lowest possible transfer price for West Coast is still the $10 variable cost per crate, plus that lost contribution margin on external sales, which is $25 selling price, minus $10 in variable cost, times just 500 crates of lost sales. And then we'll divide that by the 1,000 total crates being transferred in this potential internal transfer. Add that up and we get a lowest possible price of $17.50. Now from the buying division standpoint, nothing's still changed. That transfer price should still be less than or equal to the cost of buying from that outside supplier, or $20. Now we do have a range of acceptable transfer prices. Anything between $17.50 and $20 makes sense for the company as a whole. It's going to generate more bottom line profit for the parent company here than if we have Grocery Mart going and buying from the external market and West Coast only selling to external customers. So the two managers here should get together, figure out a price that they're comfortable with between $17.50 and $20. Now, of course, we do still set up the potential for some non-cooperative behavior, right? The manager of the selling division, they're probably not going to want to let this go for the bare minimum, so to speak, of $17.50. Just like the buying division probably doesn't want to pay sort of that max $20 that they're buying from the outside supplier. So they're going to hopefully land somewhere in the middle, something that seems fair to both, and so on. Now, to summarize a couple things we've been talking about, if a transfer within the company would result in higher profits for the company as a whole, there's always some range of transfer prices within which both divisions or both sides would also have higher profits if they agree to transfer. And so this does sort of map one-to-one and aligns incentives in that case. Now, if managers are pitted against each other rather than against past performance or some kind of benchmark, we may foster a non-cooperative atmosphere. Because of that, it's not all that uncommon for companies not to rely on negotiated transfer prices. It still is often a very difficult or delicate process, and some companies just avoid it entirely. Now, many companies will set transfer prices instead at either the variable cost or the full cost. And when we say full cost, we do mean that full absorption cost, using a term from earlier this semester, incurred by that selling division. Potential drawbacks there are that using full cost can lead to suboptimization. And this is in terms of the selling division kind of overrunning costs and not having incentives to control costs. So that really ties to number 3 at the bottom here. If we base everything on just full cost, we kind of tell the selling division, hey, you're going to get back internally whatever it takes you to produce those things. There's not a lot of incentive to control cost. Now, what that also may do, back to number one here, is cause a higher price to be incurred by the transferee, the purchasing division. And then stuck in the middle here, another point, the selling division will never show a profit on any internal transfer. So think about if you're the manager of this transferring division and you have a whole bunch of quote unquote sales coming from these transfers. You're never able to show a profit on all those internal transfers if we're using this full cost approach. Now, a market price approach is often regarded as a best or at least better approach to this transfer pricing problem. And when we say market price, we just mean the price that items could be found for or bought for in that open market from third-party suppliers. A market price approach does generally work best when the product or service being provided is being sold in its present form to outside customers, and that selling division, the transferring division, doesn't have any idle capacity. A market price approach doesn't work well when that selling division does have idle capacity. Because what we're doing is saying, hey, we're setting this price at what we'd have to buy it for in the open market, but if the selling division has idle capacity, then their costs, like their fixed costs in other words, are being sort of consumed artificially by other products that are being produced or other units that are being produced. So market price probably isn't our best bet there. It could be cheaper for us to use some other approach here. Now, tying this back real quick to what we discussed with regard to decentralization, those principles would suggest that companies should be granting managers the autonomy to set these prices and decide for themselves whether to sell internally or externally, even if that ends up resulting in some suboptimal decisions from the company's standpoint. In other words, the benefits of empowering lower-level managers, increasing their motivation because of their decision rights and their autonomy, may outweigh the potential, losses for the company, if you will, from having some transfers that are not optimal. This allows top management to, again, empower subordinates to really control their own destiny. And all things equal should make them happier and more motivated. So let's try an example here for transfer prices. Let's say the Southern Division of Barstow makes and sells a single product, which is a part used in manufacturing trucks. Annual production capacity is 12,000 units. The variable cost of each unit is $35. Presently, the Southern Division sells 11,000 units per year to outside customers at $49. The Northern Division would like to buy 4,000 units a year from Southern to use in its production. There'd be no savings in variable costs from transferring internally rather than selling externally. The lowest acceptable transfer price from the standpoint of the Southern Division should be closest to which of these four numbers? So pause the video here, work through that, and then come back when you're ready for a solution. That would be C, $45.50. So first thing we want to think about is capacity. This Southern Division has available capacity for outside sales here, 12,000 in total, minus the 4,000 that the Northern Division wants to buy, or 8,000. The lost sales to outside then would be the 11,000 that they're currently selling to outside customers, minus the 8,000, or 3,000 in total. So that transfer price is going to be greater than or equal to, the variable cost of production plus that opportunity cost. So that total lost CM is 3,000 units times the selling price of 49 minus the variable cost per unit of 35, or a total of 42,000. And now that lowest acceptable transfer price should be greater than or equal to the $35 variable cost per unit plus that lost CM of 42,000 divided by the 4,000 total units to be transferred, and that's how we get our $45.50. Okay, learning objective 4 was to charge operating departments for services provided by service departments. So just as we have internal transfers for products, we also have internal provisions of services by service departments to other departments. So we want to work on some bill back concepts for that. So just to kind of separate or define real quick here, an operating department is any department that carries out what we call the central purpose of the organization. So actual production and sales and things like that. Service departments are not directly engaged in those operating activities, also called support departments in a lot of cases, right? They're providing support or service to all the different operating departments to allow them to carry out their central purposes. Now, service department costs are charged to operating departments for a bunch of different reasons, and here's just a few. It encourages operating departments to make better use of those service department resources, right? If we don't charge them for it, in other words, they're liable to go willy-nilly with it, kind of consume those things at an unlimited rate. It helps us measure the profitability of our operating departments. It provides operating departments with more complete cost data for making decisions, tells them what it really costs to run their part of the organization, their department. And it creates an incentive for service departments to operate efficiently. If we're billing these things back to operating departments, there's going to be more attention on those total costs incurred, and that's going to hopefully encourage some efficiency there in that service department. Now, generally speaking, variable and fixed service department costs should be charged to operating departments separately. Variable costs should be charged to those consuming departments or those operating departments according to whatever activity, aka cost driver, causes the incurrence of that cost, consistent with some of the principles we've discussed earlier this term. On the other hand, we should charge fixed service department costs to those operating departments in some predetermined lump sum amounts that are based on the consuming or the operating department's peak period or long run servicing needs. Now, we do that in part because those things shouldn't vary from period to period based on activity changes or anything like that. And they're based on amounts of capacity each consuming or operating department requires. Now, a question does arise whether we should be using actual or budgeted costs for this charging process. Generally speaking, budgeted, variable, and fixed service department costs are those that should be charged to operating departments rather than actual costs. And that's done in part to help us evaluate the potential efficiency of the service department. If we always charge the actual costs from the service department to those operating departments, we wouldn't be providing much incentive for the service department to operate efficiently. In other words, they'd know that their costs were always covered. Let's look at an example then. Let's say SIPCO has a maintenance department and 2 operating departments, cutting and assembly. Variable maintenance costs are budgeted at 60 cents per machine hour. Fixed maintenance costs are budgeted at $200,000 per year. And here's some data relating to the current year. So cutting needs 60% of peak period capacity, that's service. Assembly 40%. Cutting has 75,000 hours planned, while assembly has 50,000 hours planned in terms of activity. And then hours used, cutting had 80,000, assembly had 40,000. So we want to allocate these maintenance costs to the 2 operating departments, cutting and assembly. So similar to the way we applied overhead costs to products and customers using actual activity, we're going to apply or assign service department costs to operating departments using actual activity. So we'll take the budgeted rate for these variable costs, 60 cents per hour, and multiply that by the actual hours used. So 80,000 in cutting here to get $48,000 total, 40,000 hours in assembly to get $24,000 total. And then for those allocations of fixed costs, we'll take the percentage of the peak period capacity times that budgeted fixed cost. So 60% for cutting times the 200,000 or 120,000, 40% for assembly times the 200,000 or 80,000, and then we'll add it up. That means we're allocating $168,000 to cutting and $104,000 to assembly. And we have some potential pitfalls to watch out for here in allocating fixed costs. Allocating fixed costs using a variable allocation base that fluctuates period to period doesn't necessarily align cost behavior with actual consumption. Right? If we're using this sort of moving target or this fluctuating activity base to allocate fixed costs by definition shouldn't really be moving with activity. So it might not best describe how that cost is actually being consumed, how those resources are being consumed. And then fixed costs allocated to one department in this scenario, right, are heavily influenced by what happens in other departments. So basing this on this peak period usage of all departments means it's really on a relative basis rather than an absolute basis. And again, that might not best describe how these things are really being consumed. Now, another thing to be aware of here, a potential pitfall would be using sales dollars as an allocation base, because sales of one department influence the service department costs allocated to other departments. I would add a caveat here. We call these allocations that are based on relative performance non-insulating allocations because they don't protect each division from the actions of other divisions. They are pretty frequently used in practice. So this is one area where the textbook and practice don't really line up. Research suggests that they can encourage cooperation and risk sharing, but perhaps less effort. And I've conducted a couple studies with my advisor at Indiana and another co-author where we demonstrate those things in an experimental setting. So these things are frequently observed in practice. Now let's look at another example to bring some of these things home. Autos R Us has one service department and 3 sales departments: new cars, used cars, and car parts. The service department costs total $80,000 for both years in the example. Autos R Us allocates the service department cost based on sales. So let's say in that first year, sales by department were $1,500,000 in new cars, $900,000 in used, and $600,000 over there in parts. So that's a percentage of total sales of 50%, 30%, and 20% respectively. If we're allocating based on this relative performance, that means we're allocating $40,000 in service department costs, 50% of $80,000, to the new car department there, 30% or $24,000 to used, and then $16,000 or that 20% over there to parts. Now let's also say in the next year, the manager of that new cars department increases sales by $500,000, drums up a whole bunch of new sales, new car market's high. Sales in the other departments, let's assume those are unchanged for a second. And let's allocate the same $80,000 service department cost for year 2, given this sales increase. So now the new car department here has total sales of $2 million, which represent 57% of total sales. And now they're being allocated 57% of the $80,000 service department costs, or $45,714. Used car department there is being allocated 26% of those costs because they've generated 26% of overall company sales. And then parts now is only generating 17% of total sales, so they only get allocated 17% of those service department costs. Now, we can see the problem here. If you're the manager of the new cars department, you wouldn't be thrilled with the idea that you're getting dumped a whole bunch of new service department costs just because you increase sales, just because your business is taking off, you're doing really, really well. So a lot of times these relative performance-based allocations, these non-insulating allocations, are perceived to be less fair. And that's why in the experiments I've conducted with my colleagues, we find that these things can generate lower effort, because essentially managers are being somewhat penalized, or at least not as greatly rewarded for increased performance if they're getting dumped these extra costs as a result. So that wraps up the second discussion video here for Chapter 11. As always, do let me know if you have any questions, and feel free to move on to the practice problem video.